Hello, and welcome to our guide on how to qualify for tax-exempt status in the United States. Before we begin, it is essential to state that the information provided in this entire series is for educational and informational purposes only. This is not legal, financial, or tax advice. The process of obtaining and maintaining tax-exempt status is complex and subject to specific regulations. We strongly urge you to consult with a qualified attorney or a credentialed tax professional to address your specific situation. This guide is intended to provide you with a foundational understanding to help you ask the right questions and navigate your journey. So let's start with the big question. What exactly is tax-exempt status? When you hear the term tax-exempt, you might immediately think of a nonprofit organization. And while the two are closely related, they are not the same thing. This is the first and most critical distinction you need to understand. Creating a nonprofit corporation is a matter of state law. You file articles of incorporation with your state, usually the Secretary of State's office, and you establish a legal entity that is organized for a purpose other than generating profit for private owners. This gives your organization its legal existence. Think of it like this. Registering as a nonprofit with your state gives your organization its official birth certificate. It is now a legal entity. However, being a nonprofit at the state level does not automatically mean you are exempt from paying federal income tax. That is a separate status granted by the federal government, specifically the Internal Revenue Service, or the IRS. This federal designation is what we call tax-exempt status. Following our analogy, if the state registration is the birth certificate, then getting tax-exempt status from the IRS is like getting a special license that allows your organization to operate without paying federal income tax on the income related to its exempt purpose. The primary benefit, of course, is in the name: exemption from federal income tax. For an organization dedicated to a specific mission, this is a massive advantage. It means more of the organization's revenue can go directly toward its programs and services, rather than to taxes. But the benefits don't stop there. Tax-exempt status often enhances an organization's credibility and public image. It signals that the organization has met specific federal standards. Furthermore, for many types of tax-exempt organizations, particularly the one we will discuss most, donors can deduct their contributions on their own federal tax returns. This is a powerful incentive for individuals and corporations to give, opening up significant fundraising opportunities, including eligibility for grants from foundations and the government, which often require this status. So, why does the government grant this special privilege? The rationale is rooted in the idea of public benefit. Tax-exempt organizations exist to perform tasks and provide services that are considered a benefit to society. They lessen the burden on the government by, for example, providing education, conducting scientific research, helping the poor and distressed, or promoting the arts. In exchange for providing this public good, the government forgoes the tax revenue it would have otherwise collected from that organization's income. The rules that govern these organizations are found in the Internal Revenue Code, or IRC. Specifically, Section 501(c) is the part of the code that lists the different types of organizations that can be exempt from federal income tax. While there are over 24 categories under Section 501(c), the most well-known and common type is the 501(c)(3) organization. When most people think of a charity, like the American Red Cross, a local food bank, a church, a private university, or an animal shelter, they are thinking of a 501(c)(3). These organizations are organized and operated exclusively for purposes that are considered charitable, religious, educational, scientific, literary, testing for public safety, fostering national or international amateur sports competition, or the prevention of cruelty to children or animals. Because it is the most common type of tax-exempt organization, and the one that allows for tax-deductible contributions, we will be focusing primarily on the 501(c)(3) status throughout this guide. It's important to know that other types exist, such as 501(c)(4) for social welfare organizations, 501(c)(6) for business leagues and chambers of commerce, and 501(c)(7) for social clubs. These have different rules and purposes, but the journey for most new nonprofits begins with the goal of achieving 501(c)(3) status. Now let's add one more layer to our foundation. Within the world of 501(c)(3) organizations, the IRS makes another crucial distinction. It classifies them as either public charities or private foundations. The primary difference between the two comes down to their sources of funding. A public charity generally has broad public support. It receives a significant portion of its funding from the general public, from the government, or from other public charities. For example, An organization that relies on many small donations from a wide base of individual supporters is likely a public charity. Hospitals, churches, schools, and organizations like Doctors Without Borders are all examples of public charities. The IRS presumes that an organization with such broad support is responsive to the public, and therefore subjects it to less stringent operating rules. A private foundation, on the other hand, typically derives its financial support from a very small number of sources, often a single individual, family, or corporation. The Bill and Melinda Gates Foundation is a famous example. These organizations are often referred to as private non-operating foundations, if their primary activity is to make grants to public charities rather than operating their own direct charitable programs. Because their funding isn't from the public at large, the IRS applies stricter rules to private foundations to ensure they are using their funds for charitable purposes, and to prevent self-dealing or misuse of assets by their founders or major donors. When you apply for 501(c)(3) status, the IRS will automatically classify you as a private foundation unless you can prove that you meet the requirements to be treated as a public charity. We will dive much deeper into this public support test in a later chapter, but for now the key takeaway is this. The path you take and the rules you follow will depend heavily on whether your organization is a public charity or a private foundation. So to recap our first chapter. First, being a nonprofit corporation is a state-level designation, while tax-exempt status is a separate, federal designation granted by the IRS. Second, this status is granted because the organization provides a public benefit, relieving a burden from the government. Third, the most common type of tax-exempt entity is the 501(c)(3) organization, established for charitable, religious, educational, or similar purposes. And fourth, every 501(c)(3) is further classified as either a public charity or a private foundation, based on its sources of financial support, which determines the rules it must follow. You have now taken the first step in understanding this complex, but rewarding journey. In our next chapter, we will begin to explore the foundational requirements and the crucial organizing document you will need before you can even think about applying to the IRS. Welcome back to our simple guide on qualifying for tax-exempt status in the U.S. In our last chapter, we established the fundamental difference between being a state-level nonprofit and a federally recognized tax-exempt organization. We also introduced the most common type, the 501(c)(3), and the distinction between a public charity and a private foundation. As we move forward, please remember our essential disclaimer. This series is for educational and informational purposes only and does not constitute legal or tax advice. The topics we are about to discuss involve the creation of legally binding documents. It is crucial to consult with a qualified attorney or a credentialed tax professional to ensure your organization is structured correctly and complies with all state and federal laws. With that said, let's get into the first practical step you must take on your journey: creating the organizing document. Before the IRS will even consider your application for tax-exempt status, your organization must first be formally established as a legal entity. This is done by creating and filing what the IRS calls an organizing document. The specific name of this document depends on the legal structure you choose for your organization. For a nonprofit corporation, which is the most common structure, this document is called the Articles of Incorporation. If you were to form a trust, it would be the trust instrument. For an unincorporated association, it might be a constitution. For the purpose of this guide, we will focus on the Articles of Incorporation for a nonprofit corporation, but the principles apply to other structures as well. These Articles of Incorporation are filed with your state, typically with the Secretary of State's office. This is the document that officially creates your nonprofit corporation under state law. However, and this is a point where many new organizations make a critical mistake, the standard template provided by your state is often not sufficient for getting IRS approval. The IRS requires very specific language to be included in your organizing document. If this language is missing, your application for 501(c)(3) status will be delayed or, more likely, rejected. Let's break down the 4 essential clauses that the IRS requires in your Articles of Incorporation. First is the Purpose Clause. Your document must explicitly limit your organization's purposes to one or more of the exempt purposes outlined in Section 501(c)(3). This means you must state that your organization is formed for charitable, religious, educational, scientific, or literary purposes. For example, you cannot use vague or overly broad language like, "The corporation is formed to engage in any lawful act or activity." That is language for a for-profit business. Your purpose must be narrow and specific to the mission. A standard and acceptable purpose clause might read something like this. Said corporation is organized exclusively for charitable, religious, educational, and scientific purposes, including, for such purposes, the making of distributions to organizations that qualify as exempt organizations under Section 501(c)(3) of the Internal Revenue Code, or the corresponding section of any future federal tax code. This language shows the IRS that your organization understands its scope and is committed solely to its exempt mission. The second mandatory clause is the inurement clause, also known as the private benefit clause. In simple terms, inurement means that the organization's income or assets cannot be improperly used to benefit an insider. An insider is someone who has a personal or private interest in the organization's activities, such as a founder, a board member, an officer, or a key employee. A 501(c)(3) organization's earnings must be dedicated entirely to its exempt purposes, not to enriching private individuals. Therefore, your articles of incorporation must include a statement that clearly prohibits this. The language might be, no part of the net earnings of the corporation shall inure to the benefit of, or be distributable to its members, trustees, officers, or other private persons, except that the corporation shall be authorized and empowered to pay reasonable compensation for services rendered, and to make payments and distributions in furtherance of the purposes set forth in the purpose clause hereof. This clause reassures the IRS that your organization is not a front for personal financial gain. Third, you must include a political campaign intervention clause. This is an absolute rule for 501(c)(3) organizations. They are strictly prohibited from participating or intervening in any political campaign on behalf of, or in opposition to, any candidate for public office. This includes making political contributions, endorsing candidates, or publishing statements for or against a candidate. While some lobbying activities to influence legislation may be permissible within strict limits, direct involvement in political campaigns is a line that can never be crossed. Your organizing document must reflect this prohibition. A typical clause would state, no substantial part of the activities of the corporation shall be the carrying on of propaganda, or otherwise attempting to influence legislation, and the corporation shall not participate in, or intervene in, including the publishing or distribution of statements, any political campaign on behalf of or in opposition to any candidate for public office. This demonstrates to the IRS that you understand and will abide by this critical restriction. The fourth and final essential clause is the dissolution clause. This clause answers the question, what happens to the organization's assets if it ever ceases to exist? The IRS needs to ensure that all assets acquired and accumulated for a charitable purpose will continue to be used for a charitable purpose, even if your specific organization dissolves. Therefore, your organizing document must state that upon the dissolution of the corporation, any remaining assets will be distributed to another organization with a similar exempt purpose under Section 501(c)(3), or to a federal, state, or local government for a public purpose. The assets absolutely cannot be distributed among the founders, board members, or other private individuals. This clause locks in the charitable dedication of the assets in perpetuity. So let's quickly summarize those four critical provisions required by the IRS in your organizing document. A specific purpose clause, a prohibitive inurement clause, a strict political campaign intervention clause, and a clear dissolution clause. Having these clauses correctly worded and included in the articles of incorporation you file with your state is the foundational legal step. It is the bedrock upon which your entire application to the IRS will be built. Without this solid foundation, your efforts to gain tax-exempt status will fail before they even begin. In our next chapter, we will build on this foundation by discussing the next critical steps: assembling your board of directors and drafting your bylaws, which are the internal operating rules for your organization. Thank you for listening, and please remember to consult with a professional for guidance on your specific circumstances. Hello and welcome back. In the previous chapter, we detailed the critical importance of the organizing document, your articles of incorporation, and the four essential clauses the IRS requires within it. With that legal foundation in place, we can now move to the human element of your organization, its leadership and its internal rulebook. As always, we must begin with our reminder. The information in this guide is for educational purposes only. It is not a substitute for professional legal or tax advice. Forming a board and drafting bylaws are foundational legal steps, and we strongly recommend consulting with an attorney to ensure you are compliant with your state's laws and IRS regulations. Your organization, now a legal entity on paper, needs a governing body. This is your board of directors. The board is the group of individuals legally responsible for overseeing the organization's activities. They are the fiduciaries who steer the ship, ensuring it stays true to its mission, remains financially sound, and operates within the law. The IRS and the public view the board as the ultimate authority and steward of the public trust granted to a nonprofit. Board members have three primary legal duties. The duty of care. This means they must act with the same care that a reasonably prudent person would in a similar position. They need to be informed, participate in meetings, and provide diligent oversight. The duty of loyalty. A board member must always act in the best interest of the organization, not in their own personal or financial interest. This means avoiding conflicts of interest and putting the organization's mission first. The duty of obedience. This requires board members to be faithful to the organization's mission and to ensure that it complies with all applicable laws and its own internal governing documents. When forming your initial board, your state's laws will specify the minimum number of directors required. This is often but not always 3. You must check your specific state's Nonprofit Corporation Act to be certain. While you can meet the minimum, a board of 5 to 7 members is often a good starting point for a new organization. More important than the number is the composition of your board. You should seek out individuals who are not only passionate about your cause, but who also bring a diverse set of skills and perspectives. Think about the expertise you'll need. It's wise to find people with experience in finance, law, marketing, fundraising, or specific knowledge related to your program area. Crucially, the IRS expects to see an independent board. This means the board should not be dominated by family members or individuals with close business relationships. While having a family member or 2 on the board is not automatically disqualifying, a majority of the board must be independent and unrelated. If the board is seen as a vehicle to benefit a single family or a small, insular group, the IRS may deny your application on the grounds of potential private benefit or inurement, which we discussed in the last chapter. With your board in place, the next step is to create your organization's internal operating manual, the bylaws. If the Articles of Incorporation are the Constitution, the bylaws are the specific laws that govern your day-to-day operations. They are not usually filed with the state, but they are a legally binding document that you must follow. The IRS will ask for a copy of your adopted bylaws with your application for tax-exempt status. Your bylaws must be consistent with both your state's laws and your Articles of Incorporation. They provide the detailed procedures that your articles only mention broadly. Let's walk through the essential sections that every set of bylaws should include. First, Board of Directors. This section outlines everything related to the board. How are new directors elected? What are their qualifications? How long is a term of service, and are there term limits? It should also specify the process for removing a director and for filling a vacancy if a director resigns. Second, Officers. Your bylaws must define the officer positions for your organization. The typical officers are a president or board chair, a vice president or vice chair, a secretary, and a treasurer. This section should clearly describe the duties and responsibilities of each officer. For example, the secretary is responsible for meeting minutes and corporate records, while the treasurer oversees financial management and reporting. The bylaws also specify how officers are elected and the length of their terms. Third, Meetings. This is a logistical but vital section. It dictates how often the board must meet, for example, quarterly. It defines how board members will be notified of upcoming meetings and what constitutes a quorum, which is the minimum number of directors that must be present to conduct official business and vote. Without a quorum, any decisions made are invalid. Fourth, Committees. As an organization grows, the board may need to delegate work to smaller groups. The bylaws should grant the board the authority to create committees, such as a finance committee, a fundraising committee, or a governance committee. This section should define how committee members are appointed and what their powers are. Fifth, a conflict of interest policy. This is a non-negotiable component. While the full, detailed policy can be a separate document, your bylaws must state that the organization will have one, and that directors are expected to abide by it. A conflict of interest policy is a procedure for handling situations where a board member's personal interests could potentially clash with the best interests of the organization. The IRS looks very closely for this, as it demonstrates a commitment to upholding the duty of loyalty. Finally, the bylaws must include a section on amendments. This describes the procedure for changing the bylaws in the future. It specifies who can propose an amendment, and the voting majority required to approve it, which is typically a 2/3 vote of the board. In summary, a strong, independent board provides the necessary oversight and strategic direction, while a comprehensive set of bylaws provides the clear, internal rulebook for sound governance. Taking the time to get these two elements right is a critical investment in the long-term health and compliance of your organization. In our next chapter, we will shift from governance to the practical administrative and financial tasks you must complete before you can begin filling out the main IRS application, starting with how to get your employer identification number, or EIN. Hello and welcome back to our guide. In Chapter 3, we focused on establishing the human infrastructure of your nonprofit, a strong, independent board of directors, and a clear set of bylaws to govern your operations. Now that your organization has its legal structure and its leadership, it's time to take the next practical steps to prepare for your interaction with the IRS. Before we proceed, we must reiterate our essential disclaimer. The information provided is for educational purposes only and is not a substitute for professional legal, financial, or tax advice. The processes of obtaining a federal tax ID and setting up financial accounts have significant legal and financial implications. We strongly advise consulting with a qualified professional to ensure all actions are handled correctly. The very first piece of identification your new nonprofit will need from the federal government is an employer identification number, or EIN. Think of an EIN as a social security number, but for an organization, it's a unique 9-digit number assigned by the IRS to identify your nonprofit for tax purposes. You absolutely must have an EIN before you can apply for tax-exempt status, open a bank account, or hire any employees. It is a non-negotiable prerequisite. Obtaining an EIN is a straightforward and, importantly, a free process directly from the IRS. Be cautious of websites that offer to get an EIN for you for a fee. These services are unnecessary. The fastest and most efficient way to apply is online through the official IRS website. In most cases, if you apply online, your EIN will be issued to you immediately upon successful completion of the application. You can also apply by fax or mail by filling out IRS Form SS4, but the online method is highly recommended for its speed and simplicity. To complete the application, you will need to provide specific information about your organization. This includes its legal name and address as they appear on your articles of incorporation, the date of incorporation, and the name and social security number of a designated, responsible party. The IRS defines the responsible party as the individual who has the ultimate degree of control over the organization's funds and assets. This is typically a principal officer, such as the board president, or another board member. It must be an individual, not the organization itself. This person's information is directly linked to the EIN, so it's a position of significant trust and responsibility. Once you have your EIN confirmation letter from the IRS, you can proceed to the next critical step: opening a dedicated organizational bank account. This is the cornerstone of financial transparency and a non-negotiable requirement for any legitimate nonprofit. It is absolutely forbidden to commingle funds. This means you must keep the organization's money completely separate from the personal finances of any founder, board member, or officer. Mixing organizational funds with personal funds is one of the fastest ways to lose public trust and jeopardize your tax-exempt status. A separate bank account ensures a clear financial trail and demonstrates that the organization is a distinct entity. To open a nonprofit bank account, you will typically need to provide the bank with a specific set of documents. These usually include a copy of your filed articles of incorporation, which proves your organization legally exists, your EIN confirmation letter from the IRS, which serves as your organization's tax identification, a copy of your organization's adopted bylaws, and often a board resolution. This is a formal document, signed by your board secretary, that states the board has approved the opening of the bank account and specifies which officers have the authority to sign checks and make transactions on behalf of the organization. With your EIN secured and your bank account open, you must immediately implement good financial record-keeping habits. From day one, you need a system to track every single dollar that comes into the organization and every single dollar that goes out. This includes initial startup costs, filing fees, and any early donations you might receive, even from the founders themselves. Maintaining meticulous financial records is not just good practice, it is essential for survival. This information will be required when you fill out your application for tax-exempt status, which asks for detailed financial data. Furthermore, once you are approved, you will have an annual reporting requirement to the IRS, and clean, accurate books are the only way to meet that obligation. To summarize this chapter's key actions: first, apply for your free employer identification number directly from the IRS website. Second, use your EIN and other organizing documents to open a dedicated bank account in the nonprofit's name. And third, begin tracking all financial activity immediately. These administrative and financial steps build the official infrastructure you need to operate transparently and prepare for the main application. In our next chapter, we will finally arrive at the heart of the process. We'll provide an overview of the application itself, introducing you to the primary form used to request 501(c)(3) status from the IRS, Form 1023. Hello and welcome back. In our last chapter, we handled the essential administrative groundwork, obtaining your employer identification number, or EIN, and setting up a dedicated bank account for your organization. With that financial infrastructure in place, you are now ready to approach the main event, the formal application for tax-exempt status. As we dive into this critical topic, our standard disclaimer is more important than ever. The information that follows is a high-level overview for educational purposes. It is not tax or legal advice. The Form 1023 application is a complex legal document submitted to the federal government. We strongly recommend working with a qualified professional, such as an attorney or CPA specializing in nonprofits, to prepare and review your application before submission. Errors or omissions can lead to significant delays or even denial. The official application that most organizations use to seek recognition as a 501(c)(3) tax-exempt entity is called Form 1023, Application for Recognition of Exemption under Section 501(c)(3) of the Internal Revenue Code. This form is your organization's formal case to the IRS. It is a comprehensive and detailed document where you explain what your organization is, who leads it, what it plans to do, how its activities serve an exempt purpose, and how it will be funded. It is part legal declaration, part business plan, and part financial statement. To accommodate organizations of different sizes, the IRS provides two primary versions of this application: the standard, long Form 1023, and a streamlined version called the 1023 Easy. Let's start with the standard, full Form 1023. This is the most comprehensive version of the application. It is required for any organization that anticipates its annual gross receipts will be more than $50,000 in any of its first 3 years of operation. The form consists of several parts and multiple schedules that require you to provide extensive information, including attaching your organizing documents and bylaws, providing detailed narrative descriptions of your activities, disclosing any compensation arrangements with insiders, and presenting detailed financial data from the past as well as projections for the future. In 2014, the IRS introduced Form 1023 Easy. As the Easy suggests, this is a much shorter, streamlined, online-only application designed for smaller organizations. To be eligible to use the Form 1023 Easy, an organization must project that its annual gross receipts will normally be $50,000 or less for the next 3 years, and its total assets must have a fair market value of $250,000 or less. Before you can file the Easy form, you must complete an eligibility worksheet. If you answer yes to any of the questions on the worksheet, you are ineligible. For example, organizations such as churches, schools, hospitals, and private foundations are not eligible to file Form 1023 Easy, regardless of their size. The benefits of the Easy form are that it's much faster to complete and has a lower filing fee. However, there are potential downsides to consider. Some major foundations and grant makers are hesitant to give funds to organizations that use the Easy form, as it does not require the same level of detail and planning as the full form. Also, the process of completing the long Form 1023 forces an organization to think through its mission, programs, and budget in a very thorough way, which is a valuable exercise for any new nonprofit.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Let's briefly look at the key sections of the full Form 1023 to give you an idea of its scope. Part 1 is for basic identification of your organization, name, address, and EIN. Part 2 covers your organizational structure, where you confirm that your organizing document contains the required IRS clauses we discussed in Chapter 2. Part 4 is the narrative description of activities. This is arguably the most important part of the application. Here, you must describe in detail all of your past, present, and planned activities. You need to explain precisely how these activities will accomplish your charitable, educational, or other exempt purposes. Part 5 delves into compensation and financial arrangements with your officers, directors, and key employees to ensure there is no prohibited private benefit. Part 9 is the financial data section. Here, you must provide a statement of revenues and expenses for any years you've already been in existence and, crucially, a detailed projected budget for at least the next 2 years. Finally, a quick but important note on fees. Submitting either form requires the payment of a non-refundable user fee to the IRS. As of late 2024, the fee for the Form 1023 Easy was $275, and the fee for the standard Form 1023 was $600. These fees are subject to change, so you must verify the current amount on the IRS website. The application and the fee must be submitted electronically through the federal government's pay.gov portal. To recap, the Form 1023 is the central application where you make your case to the IRS. You must determine whether you are eligible for the streamlined Easy form, or if you need to complete the more comprehensive long form. Both require careful preparation, accurate information, and a non-refundable filing fee. In our next chapter, we will focus on how to craft a compelling and compliant response to the most critical part of the application, the narrative description of your activities. Hello and welcome back to our simple guide. In the last chapter, we introduced the main application for tax-exempt status, Form 1023, and its streamlined version, Form 1023 Easy. Now we are going to focus on what is arguably the most important section of that entire application, the narrative description of your activities. Before we begin, please remember our most important rule. This content is for educational guidance only and is not legal or tax advice. The narrative you submit to the IRS is a factual and legal declaration of your organization's purpose and programs. It must be truthful, accurate, and carefully written. We highly recommend having a qualified professional review your narrative before you submit it. The narrative description of your activities is the heart and soul of your application. It is where you move beyond legal jargon and financial figures to tell the story of your organization. The IRS agent reviewing your file has one primary goal: to determine if your organization's activities exclusively serve the 501(c)(3) exempt purpose you claimed in your articles of incorporation, be it charitable, educational, scientific, or religious. This narrative is your single best opportunity to prove that you meet this fundamental requirement. The agent needs to read your description and come away with a crystal clear understanding of exactly what you do, who you do it for, where you do it, and how you do it. Vague, aspirational language is a major red flag for the IRS. To help structure your thinking, you can use a simple framework. Think of the word FLAG. Each letter represents a key principle for crafting your narrative. F stands for factual and specific. Avoid broad, generic statements like, "We will help the community," or "We will work to improve literacy." These statements are meaningless to a reviewer. You must provide concrete details. Instead of saying, "We will help the homeless," a better description would be, "We will operate a mobile food kitchen on Tuesday and Thursday evenings from 6 p.m. to 8 p.m. in downtown Central City. We will park at 123 Main Street and anticipate providing hot, nutritious meals to approximately 50 individuals experiencing homelessness each night of operation." That level of detail paints a clear picture. L stands for link to purpose. Every single activity you describe must have a direct and obvious connection to your exempt purpose. If your purpose is educational, you need to show how your activities are educational. For example, to further our educational purpose, we will conduct free, weekly financial literacy workshops for low-income adults in our community. These 90-minute workshops, held at the public library, will cover essential topics such as personal budgeting, understanding credit, and managing debt. We will use a curriculum developed by certified financial planners. A stands for activities, past, present, and planned. The IRS needs the complete story of your organization's programmatic work. Your narrative must thoroughly describe all three phases. If you have been operating for some time before applying, describe your past activities. Detail your present activities, what you are doing right now. Most importantly, for new organizations, you must describe your planned activities. Be just as specific about your future plans as you are about your current ones. This shows the IRS that you have a viable, well-conceived plan for the future. G stands for governance and guardrails. How are your programs managed? This part of the narrative should briefly explain the operational side. Who is responsible for conducting the activities? Are they volunteers or will you have paid staff? How will the programs be funded? Mentioning that the board of directors will oversee the programs and review their effectiveness adds a layer of credibility. This shows the IRS that you have not only a mission, but also a structure in place to carry it out responsibly. So, as you write, ask yourself if your narrative answers these key questions. What are the specific activities? E.g., workshops, mentoring sessions, scientific research, food distribution. Who is the specific group that will benefit from these activities? When and how often will the activities take place? Where geographically will the activities be conducted? How will the activities be funded? E.g., public donations, grants, program service fees. And who will conduct them? Finally, be careful to avoid common mistakes. The most common is vagueness. The second is inconsistency. The activities you describe must align with the financial data you provide elsewhere in the application. If your budget shows you plan to spend 50% of your funds on a specific program, you need to describe that program in significant detail in your narrative. In summary, your narrative is your chance to make a clear, compelling, and factual case to the IRS. Use the FLAG framework to ensure it is factual, linked to your purpose, describes all activities, and touches on governance. In our next chapter, we will turn our attention to the numbers, focusing on how to prepare the crucial financial data for your application, including your budget and future projections. Hello and welcome back. In our last chapter, we delved into the heart of the Form 1023 application, crafting a detailed and compelling narrative of your organization's activities. Now, we turn to the section that must support and align with that narrative, your financial data. The numbers must tell the same story as your words. As we are about to discuss financial matters, our disclaimer is critically important. The information in this chapter is for educational purposes only and is not financial, accounting, or tax advice. Preparing financial statements and projections requires a specific skill set. We strongly recommend that you work with a qualified accountant or a CPA, preferably one with experience in the nonprofit sector, to ensure your financial data is accurate, realistic, and correctly formatted for the IRS. So, why does the IRS require such detailed financial information? This section serves three primary purposes. First, it demonstrates your organization's financial viability. It shows the IRS that you have a realistic plan to fund the programs you described in your narrative. Second, it provides the IRS with the information it needs to make an initial determination about your classification as a public charity versus a private foundation. And third, it serves as a check against private inurement by providing a transparent look at how you plan to spend your funds. The financial portion of Form 1023 requires you to look both backward and forward. If your organization has been in existence for some time before applying, you will need to provide a statement of revenue and expenses with your actual, historical financial data. However, for most new organizations, the key component is the proposed budget. This is a detailed financial projection for your first few years of operation. The form will specify the exact number of years required. This budget cannot be a wild guess. It must be a thoughtful, realistic estimate directly tied to the activities you described in your narrative. Let's break down how to approach building this budget conceptually. First, you need to project your support and revenue, which is your income. You will need to separate your income into different categories. The most important category for a public charity is contributions, gifts, and grants. This is the money you anticipate receiving from individual donors, private foundations, government grants, and corporate giving. Other categories include program service revenue, which is income generated directly from your exempt activities, such as ticket sales for a community theater, tuition for an educational class, or fees for a counseling service. When projecting this income, be realistic and specific. On what are you basing these numbers? Do you have specific fundraising events planned? Have you identified potential grant opportunities? Will the initial funding come from the board of directors themselves? A well-reasoned projection is far more credible than an overly optimistic one with no clear basis. Next, you must project your expenses. The IRS requires you to break down your expenses into three functional categories. Program service expenses. These are the costs directly related to carrying out your mission. This should be the largest portion of your expenses. Examples include supplies for a homeless shelter, printing costs for educational pamphlets, or salaries for program staff. Management and general expenses. These are your overhead or administrative costs. They are the expenses required to run the organization itself, but not tied to a specific program. Examples include legal fees, accounting services, office rent, insurance, and the salaries of administrative staff. Fundraising expenses. These are the direct costs of soliciting contributions. Examples include the costs of printing and mailing fundraising letters, the expenses for a fundraising event, or fees paid to a grant writer. The most important part of this entire exercise is the alignment check. Your budget and your narrative must be in perfect sync. If your narrative describes 3 major programs, your budget's expense section should have costs allocated to those 3 programs. If you project a significant amount of grant income, your narrative should mention your plans for grant seeking. Any mismatch between your words and your numbers will raise a red flag and cause the IRS to question your application. Finally, remember our discussion about public charities and private foundations? Your revenue projections are what the IRS will use to make its initial determination about your status. The public support test essentially measures what percentage of your income comes from the general public versus a small number of major donors. If your budget shows that 95% of your funding will come from a single family or individual, the IRS will likely classify your organization as a private foundation. If, however, your budget shows diverse sources of income from many different donors, grants, and program services, you have a much stronger case for being classified as a public charity from the outset. In summary, the financial section of your application provides the quantitative evidence to back up your qualitative story. It requires a realistic, detailed, and well-considered budget that is directly aligned with your planned activities. In our next chapter, we will discuss the final steps of the process: assembling your complete application package, paying the user fee, and what you can expect after you hit the submit button. Hello and welcome back. In our previous chapter, we navigated the critical process of preparing your organization's financial data, ensuring that your budget and projections provide a solid, realistic foundation for the activities you described in your narrative. Now, with all the major components prepared, we arrive at the final steps before your application begins its journey to the IRS: the final review and submission. As this chapter deals with the formal submission of a legal application to the federal government, our disclaimer is especially important. The information here is a procedural overview for educational purposes and is not legal advice. Submitting an application to the IRS is a significant legal act. The most prudent course of action is to have a qualified professional, such as an attorney or a CPA specializing in nonprofits, conduct a final review of your entire application package before you file it. Think of this stage as the measure twice, cut once phase. A thorough final review can be the difference between a smooth process and months of frustrating delays. Here is a checklist of what to focus on. First, the completeness check. Go through every single line of the Form 1023. Have you answered every required question? Leaving a required field blank is one of the most common reasons for an application to be immediately sent back or delayed. Double-check that all your attachments are complete, correctly labeled, and in the proper format. Next, conduct a specific attachments review. You will be uploading several key documents, and you must ensure you have the correct versions. This includes a conformed copy of your articles of incorporation. This means a copy that includes the signature of the state official and a stamp or seal showing it was filed with the state. A complete copy of your adopted bylaws, signed by your board secretary. Your complete financial data, including both historical statements if applicable, and your detailed future projections. Any other required schedules that apply to your specific type of organization, such as a school or hospital. The third and perhaps most critical review is the consistency check. Every document in your package must tell the same story. Does the legal name of your organization match exactly across your articles of incorporation, your bylaws, your EIN confirmation letter, and the Form 1023 itself? Even a minor difference, like including ink in one place but not another, can cause confusion and delays. Does your narrative perfectly align with your budget? Are the officer and director names consistent throughout? Finally, confirm the signature and authorization. The application must be signed electronically by an individual who is authorized to do so, such as a board officer or director. This person is signing under penalties of perjury, a formal legal declaration that everything contained in the application is true, correct, and complete to the best of their knowledge. This step underscores the seriousness of the document you are about to submit. Once your review is complete, you are ready for submission. The entire process is now electronic. The IRS no longer accepts paper applications for Form 1023. You must file through pay.gov, which is the secure online portal used by federal agencies to collect forms and payments. The process on pay.gov is straightforward. You will create an account, find the correct version of Form 1023, and fill in the required information. You will then upload all of your attachments as PDF files. The final step is to pay the non-refundable user fee electronically, using a bank account or a credit card. Once you submit, you will receive an electronic confirmation receipt. It is essential that you save and print this receipt for your organization's permanent records. So, what happens after you hit submit? This is where patience becomes a virtue. You will typically receive an acknowledgement letter from the IRS within a few weeks, confirming they have received your application. This is not an approval. Your application will then be assigned to a reviewing agent in the IRS's Exempt Organizations Division. It is very common for the agent to have follow-up questions. They may send a written request for more information or for clarification on your activities or finances. If you receive such a letter, it is vital that you respond promptly, completely, and by the specified deadline. The entire process, from submission to final determination, can take anywhere from a few months to more than a year, depending on the complexity of your case and the IRS's backlog. A common question is, can we operate while the application is pending? The answer is yes. You can begin your programs and even solicit donations. You should be transparent with your donors, informing them that your 501(c)(3) status is pending. If your application is approved, and you filed it within 27 months of your legal formation, your tax-exempt status will be effective retroactively to your formation date. This means any donations you received while pending become retroactively tax-deductible for the donor. In our next chapter, we'll discuss the moment you've been waiting for: receiving your determination letter from the IRS, and the immediate responsibilities that come with being a newly recognized tax-exempt organization. Hello and welcome back to our guide. In our last chapter, we walked through the final review and electronic submission of your application, and we discussed the patience required during the subsequent waiting period. This chapter is about what happens at the end of that wait: the official response from the IRS and the pivotal shift from seeking status to maintaining it. As we will be discussing official IRS communications and ongoing legal obligations, our standard disclaimer is essential. This information is for educational purposes only and does not constitute legal or tax advice. Understanding and fulfilling your compliance duties as a tax-exempt organization is a serious legal responsibility. We strongly urge you to consult with a qualified professional to ensure you remain in good standing. After months of waiting, a letter from the IRS will arrive. This is the determination letter, and it is the official legally binding document that declares the outcome of your application. Hopefully, you will receive a favorable determination letter. This is the document you have been working towards. It will state that the IRS has recognized your organization as exempt from federal income tax under Section 501(c)(3). This letter is critically important and will contain several key pieces of information: your organization's official name and EIN, the effective date of your tax-exempt status, and crucially, your classification as either a public charity or a private foundation. It will also confirm that contributions made to your organization are tax-deductible for donors. On the other hand, it is possible to receive an adverse letter, which is a denial of your application. The letter will explain the IRS's reasons for the denial. While there is a formal appeals process, this is a complex and challenging legal path that should not be undertaken without the guidance of an attorney experienced in this specific area of law. But let's focus on the positive outcome. You're approved. After a moment of celebration, it's time to get organized. Your first step should be to safeguard the original determination letter. This is one of the most important documents your organization will ever possess, and should be kept in a permanent, safe place. You will need to provide copies of it countless times when applying for grants, opening new bank accounts, and proving your status to major donors. Next, you must apply for your state tax exemptions. Remember, 501(c)(3) status is a federal tax exemption. It does not automatically exempt you from state taxes, such as corporate income tax, sales tax, or property tax. You must file separate applications with your state's Department of Revenue. Your federal determination letter will be the primary piece of evidence you need for these state-level applications. Receiving your 501(c)(3) status is not the end of the journey. It is the beginning of a new set of responsibilities. Your primary ongoing duty is the annual filing requirement. With very few exceptions, such as for most churches, every 501(c)(3) organization must file an annual information return with the IRS. This is known as the Form 990 series. This is not a tax return, as you are exempt from paying income tax. Instead, it is a transparency and accountability tool. The Form 990 provides the IRS and the public with a detailed look at your organization's finances, activities, governance, and compensation of top officials for the year. There are several different versions of the form, and the one you file depends on your annual gross receipts. The Form 990-N, also known as the e-postcard, is for the smallest organizations, typically those with gross receipts of $50,000 or less. The Form 990-EZ is for mid-sized organizations. And the full Form 990 is for larger organizations with higher levels of revenue and assets. This annual filing is not optional. The law is incredibly strict on this point. If an organization fails to file its required Form 990 for 3 consecutive years, its tax-exempt status will be automatically revoked by the IRS. This is a critical rule to understand from day one. Another key responsibility is maintaining your public charity status. For most new organizations, the IRS grants public charity status on a provisional basis for the first 5 years. During this initial 5-year period, your organization must demonstrate that it can actually meet the public support test that you projected in your application. You will report your sources of income on your annual Form 990, and the IRS will use this information to confirm that you are, in fact, broadly supported by the public. In summary, the determination letter is the official document that grants your tax-exempt status. Once you receive it, your focus must immediately shift to ongoing compliance. This includes securing state tax exemptions, and most importantly, fulfilling your annual IRS filing requirement with the Form 990 to avoid automatic revocation of your status. In our next chapter, we will take a closer look at the Form 990 series and what you need to know to prepare for your first annual filing. Hello and welcome back to our guide. In the last chapter, we celebrated the arrival of your favorable determination letter and outlined the immediate shift in focus from application to ongoing compliance. We identified the annual Form 990 filing as your most critical ongoing responsibility. In this chapter, we will take a closer look at this essential annual check-in. As we will be discussing a mandatory IRS filing in detail, we must begin with our core disclaimer. This overview is for educational purposes only and is not tax or accounting advice. The Form 990 is a legal document, and its accurate and timely filing is a serious obligation. We strongly recommend that your organization works with a qualified accountant or CPA to prepare its annual information return. First, let's re-emphasize the purpose of the Form 990. It is an information return, not a tax return. Its purpose is twofold: compliance and transparency. For the IRS, it's a tool to ensure that your organization continues to operate in accordance with the rules for 501(c)(3) entities. For the public, it is a window into your organization. Donors, grant makers, researchers, and journalists all use Form 990s to understand your mission, evaluate your financial health, and see how you are governed. A well-prepared Form 990 can be a powerful tool for building trust and attracting support. As we briefly mentioned, there are 3 main versions of the form. The one you file depends on your organization's finances. Form 990-N, known as the e-postcard, is for the smallest organizations, those whose gross receipts are normally $50,000 or less. This is a simple online notification that confirms your organization is still active. Form 990-EZ is for organizations with gross receipts of less than $200,000 and total assets of less than $500,000. It is a 4-page return that is more detailed than the e-postcard, but simpler than the full form. The full Form 990 is required for larger organizations that exceed the thresholds for the 990-EZ. This is a comprehensive, 12-page document with numerous potential schedules. It is important to note that an organization can always choose to file a more comprehensive form than required. For example, a small organization eligible for the 990-N might choose to file a 990-EZ to provide more information and transparency to potential funders. To truly appreciate the scope of this filing, let's take a high-level tour of the main sections of the full Form 990. Part 1 is the summary. This is a 1-page snapshot of your organization, covering its mission, key activities, and a summary of its revenue, expenses, and assets. For many people, this is the only part of the return they will ever read. Part 3 is the Statement of Program Service Accomplishments. This is the narrative heart of the return. Here, you describe your organization's 3 largest programs by expenses, explaining what you accomplished during the year, and how those accomplishments further your exempt mission. Part 6 covers governance, management, and disclosure. This section is a lengthy checklist of yes or no questions about your organization's policies and procedures. It asks things like, did the organization have a written conflict of interest policy? And were the minutes of the board meetings documented? A high number of no answers can be a red flag to the IRS and savvy donors. Part 7 is focused on compensation. This is where you must disclose the compensation paid to your officers, directors, trustees, key employees, and highest paid staff. This section is scrutinized very closely by the public and the media to ensure that funds are not being used for excessive salaries. The filing deadline for the Form 990 is the 15th day of the 5th month after your organization's fiscal year ends. For the vast majority of organizations that use a standard calendar year ending December 31st, the due date is May 15th. If you need more time, you can get an automatic 6-month extension by filing a simple form called Form 8868. Failing to file on time can result in significant financial penalties levied by the IRS, which accrue for each day the return is late. And as we warned in the last chapter, failing to file for 3 consecutive years results in the automatic loss of your tax-exempt status. Finally, remember that your Form 990 is a public document. Your organization is legally required to make its 3 most recent returns available for public inspection. Furthermore, organizations like Candid, formerly GuideStar, and ProPublica automatically post these forms online, making your financial and operational details accessible to anyone with an internet connection. In our next chapter, we will discuss the best practices for year-round record-keeping and financial management that will make preparing your annual Form 990 a much smoother and less stressful process. Hello and welcome back. In our last chapter, we took a deep dive into the annual Form 990, your organization's most important yearly filing. Many new nonprofit leaders view this filing as a stressful, once-a-year event. However, the key to a smooth and accurate filing process is not what you do in the weeks before the deadline, but what you do all year long. This chapter is about those year-round best practices for record-keeping and financial hygiene. Before we proceed, it is essential to state our standard disclaimer. This information is for educational purposes and should not be considered as accounting, financial, or legal advice. Every organization's needs are different, and you should establish your record-keeping systems with the guidance of a qualified accounting professional. Meticulous record-keeping is not just about making tax time easier. It is a fundamental pillar of a healthy, compliant, and trustworthy nonprofit organization. Good records are essential for several reasons. First, it's a matter of compliance. Federal and state laws require you to maintain accurate books and records of your finances and activities. Second, it's crucial for effective management. Your board cannot make sound strategic decisions about budgets and programs without accurate and timely financial information. Third, it builds donor trust. Being able to quickly and clearly show a supporter how their funds were used builds the credibility that is essential for long-term fundraising success. So, what records do you need to keep? Let's break them down into 2 main categories: corporate records and financial records. Corporate records document your organization's governance and legal structure. This includes permanent documents that you should never discard, such as your articles of incorporation, your bylaws, and your original IRS determination letter. It also includes the official minutes from all board of directors and committee meetings. These minutes are the legal record of the board's decisions and demonstrate that it is providing active oversight as required by law. Financial records, on the other hand, document every transaction the organization makes. This starts with your bank and credit card statements, which should be reconciled every single month. It includes detailed documentation for every dollar you spend. This means keeping every receipt, invoice, and contract. A good rule of thumb for your staff and volunteers should be: no receipt, no reimbursement. For income, the most critical records relate to the donations you receive. This is not just for your own accounting, but it is a legal requirement you have to help your donors. For any single donation of $250 or more, a donor cannot claim a tax deduction unless they have a formal written acknowledgement from your organization. This is often called a substantiation letter. This letter must contain specific information: your organization's name, the date of the contribution, the amount of the cash donation, and a statement confirming that no goods or services were provided by the organization in exchange for the contribution. The rules get a bit more complex if the donor does receive a benefit. This is called a quid pro quo contribution. A common example is a ticket to a fundraising dinner. If a donor pays $100 for a ticket, and the fair market value of the meal is $40, you must state in your acknowledgement that the donor's tax-deductible contribution is only $60, the amount they paid that exceeds the value of what they received. Properly tracking and acknowledging donations is a non-negotiable part of operating a 501(c)(3). To manage all of this, you need a system. For a very new organization with very few transactions, this system might start as a simple set of spreadsheets. However, as you grow, you will quickly need to upgrade to a dedicated accounting software package. There are many options available, some of which are specifically designed for the unique needs of nonprofits. The most important thing is to choose a system that you can manage effectively and that provides accurate, timely, and easy-to-understand reports for your board. In summary, treating record-keeping as a continuous, year-round activity is essential. It is the foundation of legal compliance, good governance, and public trust. By keeping your corporate and financial records organized from day one, you not only make your annual Form 990 filing easier, but you also build a stronger, more resilient organization. In our next chapter, we will shift our focus to another critical compliance area: the rules and regulations surrounding fundraising and the requirement to register in states where you solicit donations.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Hello and welcome back. In our last chapter, we emphasized the critical importance of diligent, year-round record-keeping as the foundation for good governance and easier annual reporting. Now we'll shift our focus from internal compliance to a crucial external compliance area: the rules that govern how you raise money. This chapter addresses a complex and highly regulated area of law. Therefore, our disclaimer is more important than ever. The following is a general educational overview and is not legal advice. Charitable fundraising laws vary significantly from state to state. It is essential that you consult with a legal professional or a specialized compliance service to understand and fulfill your specific obligations. Once you receive your 501(c)(3) status, you have the IRS's permission to receive tax-deductible contributions. However, that does not automatically give you the right to ask for those contributions wherever you want. The act of asking for a donation is called charitable solicitation, and it is regulated by most states. Currently, about 40 states have laws requiring nonprofits to register with a state agency, typically the Attorney General's office or the Secretary of State, before they solicit any donations from residents of that state. Think of it like this: your 501(c)(3) status is your federal license to be a charity, but you may need a separate state license to fundraise in each specific state. The purpose of these laws is to protect consumers from fraudulent charities and to ensure transparency in the nonprofit sector. So what does it mean to solicit? The definition is much broader than you might think. It's not just about hosting a fundraising gala or making phone calls. Solicitation can include sending fundraising emails or letters, applying for grants from a foundation based in that state, or even just having a Donate Now button on your website. That last point is a critical one for modern nonprofits. A website is accessible from anywhere, so a Donate Now button can be interpreted by many states as a solicitation of their residents, thereby triggering a registration requirement in those states. This is a compliance trap that many new, small organizations fall into. The registration process typically involves an initial filing and annual renewals. For the initial registration, you will usually need to submit an application form, pay a filing fee, and provide copies of your core organizational documents, such as your articles of incorporation, bylaws, and your IRS determination letter. This is not a one-and-done process. You must then renew your registration every year in each state where you are registered. The renewal process usually involves submitting a renewal form, paying another fee, and providing a copy of your most recently filed Form 990. The fees are often on a sliding scale based on your organization's annual revenue. To simplify the paperwork, a number of states accept what is known as the Unified Registration Statement, or URS. This is a standardized application form that can be used for a group of participating states. However, while the URS standardizes the main form, it doesn't eliminate the need to file in each state individually. You will still have to pay separate fees and often submit state-specific supplemental forms. What happens if you don't comply? The consequences can be severe. States can impose financial penalties and late fees, issue cease and desist orders, and even hold your organization's directors and officers personally liable. Noncompliance can also lead to negative publicity and a loss of trust from your donors. In summary, fundraising is a legally regulated activity. Receiving your 501(c)(3) status is just the first step. To legally solicit funds from the public, you must also navigate the web of state charitable solicitation laws, which requires proactive registration and diligent annual renewals in the states where you fundraise. In our next chapter, we will explore another important IRS compliance topic: What happens when a nonprofit earns income from activities that are not directly related to its exempt mission? A concept known as unrelated business income. Hello and welcome back. In our last chapter, we navigated the complex web of state-level fundraising registration requirements. Today, we turn our attention back to the IRS and another critical area of ongoing financial compliance. What happens when your nonprofit earns income from activities that look more like a for-profit business? This is one of the most complex areas of nonprofit tax law. Therefore, our disclaimer is absolutely essential. This chapter provides a high-level educational overview and is not tax or legal advice. Determining whether an activity generates taxable income requires a careful analysis of your specific facts and circumstances, and you must consult with a qualified tax professional on this matter. The term nonprofit can be misleading. It doesn't mean an organization cannot make a profit. It simply means that any profit or surplus cannot be distributed to private owners. A healthy nonprofit should aim to bring in more revenue than it spends. Your tax-exempt status means you are exempt from federal income tax on revenue that is related to your charitable, educational, or other exempt purposes. However, if your organization earns significant income from an activity that is not related to your mission, that income may be subject to tax. This is called unrelated business income, or UBI. The tax itself is called the unrelated business income tax, or UBIT. The IRS uses a three-part test to determine if an activity's income is UBI. The activity must be a trade or business, regularly carried on, and not substantially related to the organization's exempt purpose. If an activity meets all three of these criteria, the net income from it is likely taxable. Let's break them down. First, is it a trade or business? This is a broad definition that includes almost any activity carried on to produce income from selling goods or performing services. For example, if a museum operates a gift shop, that gift shop is considered a trade or business. Second, is it regularly carried on? This test looks at the frequency and continuity of the activity. Is it conducted with the same consistency as a similar for-profit business? Our museum's gift shop, which is open year-round, is clearly regularly carried on. In contrast, a church holding a bake sale once a year would generally not be considered regularly carried on. Third, and this is the most important test, is the activity not substantially related to your exempt purpose? To be related, the activity itself must contribute importantly to achieving your mission, beyond just providing money. Let's go back to our museum, whose exempt purpose is educational. If its gift shop sells art history books, educational toys, and high-quality reproductions of the art in its collection, this activity is substantially related. It directly furthers the museum's educational mission. The income is not UBI. But what if that same museum decides to operate a public parking lot next door and charges market rates? While this might be a great source of revenue, the act of operating a commercial parking lot does not, in itself, contribute importantly to the museum's educational mission. It's a trade or business, it's regularly carried on, and it's not substantially related. Therefore, the income would likely be considered UBI. Now, there are numerous exceptions and modifications to these rules. For example, income from a business where substantially all the work is performed by unpaid volunteers is generally not considered UBI. Also, income from the sale of donated merchandise, the entire basis of most thrift stores, is also exempt. There are also broad exceptions for passive income such as interest, dividends, and certain types of rent and royalties. If your organization does have unrelated business income, you must file a separate tax return. Form 99DT, Exempt Organization Business Income Tax Return. This is not an information return, it is a tax return. You must calculate your net income from the unrelated activity and pay tax on it at the same rates as for-profit corporations. This isn't just about paying taxes. If an unrelated business activity becomes too large and substantial a part of your organization's overall operations, it can actually jeopardize your 501(c)(3) status. Your organization must be operated primarily for its exempt purpose. If it begins to look and operate more like a for-profit business than a charity, the IRS could revoke your exemption entirely. In our next chapter, we will discuss another highly regulated area of nonprofit activity: the rules surrounding lobbying, advocacy, and political campaign intervention. Hello and welcome back. In our last chapter, we explored the complex rules surrounding unrelated business income tax, or UBIT. We learned that a nonprofit's income is only tax-exempt when it is related to its mission. Today, we're going to discuss another critical compliance boundary: the line between permissible advocacy and prohibited political activity. This is one of the most misunderstood and strictly enforced areas of nonprofit law. For that reason, our disclaimer is paramount. This is an educational overview and is not legal advice. The rules distinguishing permissible lobbying from prohibited political campaign activity are complex and nuanced. Your organization must consult with legal counsel specializing in nonprofit law before engaging in any advocacy efforts to ensure you remain compliant. Let's begin with the brightest possible red line. Under the Internal Revenue Code, a 501c3 organization is absolutely prohibited from directly or indirectly participating in, or intervening in, any political campaign on behalf of, or in opposition to, any candidate for elective public office. There is zero ambiguity and zero tolerance for violating this rule. It is a foundational condition of 501c3 status. This prohibition means your organization cannot endorse or oppose a candidate for office, make financial contributions to a political campaign or party, publish or distribute statements for or against a candidate, or rate candidates on their positions. A violation of this absolute ban can, and often does, result in the revocation of an organization's tax-exempt status. While your organization cannot intervene in an election to choose who makes the law, it can, within limits, work to influence the laws themselves. This is called lobbying. The key distinction is between influencing policy versus influencing elections. Lobbying is about the issues, not the candidates. For public charities, this does not apply to private foundations. The law states that no substantial part of their activities may be attempting to influence legislation. So what does that mean? The IRS defines two types of lobbying. Direct lobbying is any communication with a legislator, their staff, or a government official involved in creating legislation, where you express a view on a specific piece of legislation. For example, if the director of a literacy nonprofit meets with a state senator to urge them to vote in favor of a bill to increase library funding, that is direct lobbying. Grassroots lobbying is an attempt to influence legislation by shaping public opinion. It has two parts. The communication must refer to specific legislation, and it must include a call to action, which is language that encourages the public to contact their legislators. For example, if that same literacy nonprofit sends an email to its supporters that describes the library funding bill and ends with the message, "Please call your senator today and ask them to support this bill," that is grassroots lobbying. The challenge is the term substantial part. The default test the IRS uses to measure this is vague. It's a facts and circumstances test that looks at the time and money spent on lobbying in relation to all other activities. Because this test is so subjective, it can be difficult for organizations to know if they are approaching the line. Fortunately, there is a clearer, safer option. Public charities can make a simple, one-time election called the 501h election. By filing Form 5768, an organization can choose to have its lobbying activities measured by a more precise expenditure test. This test replaces the vague substantial part standard with a specific dollar-based limit on how much money the organization can spend on lobbying. The limits are on a generous sliding scale based on the organization's total exempt purpose expenditures. The 501h election is a safe harbor. It provides a clear mathematical line, so the organization knows exactly how much it can spend on lobbying without putting its tax-exempt status at risk. It's also important to know that many advocacy activities are not considered lobbying at all. These can include conducting nonpartisan analysis, study, or research on a public issue, providing technical assistance to a legislative body in response to a written request, and discussing broad social and economic problems without referencing specific legislation. In summary, the rules are clear. There is an absolute and total ban on participating in political campaigns for or against candidates. Lobbying to influence legislation, on the other hand, is a permissible activity for public charities, as long as it is not a substantial part of their overall work. And organizations can elect to use the 501h expenditure test for a clear, dollar-based limit on their lobbying activities. In our final chapter, we will summarize the key takeaways from this entire series and look ahead at the ongoing life of a healthy, compliant, and impactful 501c3 organization. Hello, and welcome to the final chapter of our simple guide on qualifying for tax-exempt status in the United States. We have traveled a long road together, from the initial spark of an idea to the ongoing responsibilities of a fully compliant 501c3 organization. In this concluding chapter, we will summarize the key milestones of our journey and look ahead to the principles that will guide your organization for years to come. Before we conclude, it is essential that we state our final and most important disclaimer. This entire series has been created for educational and informational purposes only. It is not, and has never been intended as, a substitute for professional legal, accounting, or tax advice. The world of nonprofit compliance is complex and ever-changing. Your greatest asset on this journey will be a team of qualified professional advisors. Let's take a moment to look back at the path we've covered. We began by laying the foundation, understanding the difference between a state-level nonprofit and a federal 501(c)(3), and drafting the critical articles of incorporation with the specific language the IRS requires. We discussed assembling an independent board of directors, writing your operational rulebook in the bylaws, and taking the first official steps of obtaining your EIN and opening a bank account. From there, we moved to the application itself. We demystified the Form 1023, explaining the difference between the full form and the streamlined, easy version. We focused on crafting the heart of the application, the detailed narrative of your activities, and preparing the realistic financial projections that must support that narrative. We walked through the final review and the electronic submission process, and the patient wait for your determination letter. Finally, we explored the world of ongoing compliance that begins the moment you are approved. We emphasized the absolute necessity of the annual Form 990 filing, and the harsh penalty for failing to file. We covered the importance of year-round record-keeping, the complex web of state fundraising registrations, the rules for unrelated business income, and the critical line between permissible lobbying and the absolute prohibition on political campaign activity. As you move forward, remember that a healthy and sustainable nonprofit is built on 4 key pillars. The first is good governance. Your organization's strength starts in the boardroom. An engaged, independent board that provides diligent oversight, strategic direction, and asks tough questions is your most valuable asset. Follow your bylaws, document your decisions in meeting minutes, and always prioritize your duty of care, loyalty, and obedience. The second pillar is financial stewardship. As a 501(c)(3), you are a steward of public funds. This requires sound financial management, including realistic budgeting, strong internal controls to protect your assets from fraud or misuse, and transparent financial reporting. Every decision must honor the trust that your donors and your community have placed in you. The third pillar is an unwavering commitment to mission. Your exempt purpose is your North Star. Every program you run, every dollar you spend, and every decision your board makes should be guided by the question, does this further our mission? This is what keeps your organization on track and ensures your activities remain substantially related to your purpose. The final pillar is a culture of compliance. View these rules and regulations not as a burden, but as the framework that protects your organization and the entire nonprofit sector. Build systems to ensure compliance becomes a habit, from sending timely donation acknowledgments to filing your Form 990 on time, every single year. The journey to creating and leading a 501(c)(3) organization is challenging. The responsibilities are significant. But the purpose behind this work is what truly matters. The legal structures, the application forms, and the compliance rules all exist for one reason: to safeguard the public trust so that organizations like yours can effectively serve our communities, enrich our culture, advance knowledge, and care for those in need. Thank you for joining us for this guide. We hope it has provided you with a clear roadmap and a solid foundation of knowledge. We wish you the very best as you embark on the rewarding journey of leading a successful, impactful, and compliant nonprofit organization.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.